Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be taking a look at what stop losses are and why you should use one. I'll also cover the Dow Jones and this week's stocks of interest. If you're regular to this channel, welcome back, and if you're joining us for the first time, let me extend a big welcome to you. I'm sure by watching these videos you will gain some great insights and inspiration as to how you can confidently and profitably trade the stock market. And as always, if you have any topics you want me to cover or you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. Also, before I get into the report, click the like button just below. All done? Great. So let's get into this week's report. One of the key criteria of astute investing, no matter what the investment may be, is to consider when and how you will take your profits. In other words, you need to consider your exit strategy. When it comes to the stock market, it's how you will apply your stop loss to protect your capital before you decide to invest. As many of you will have heard me say many times before, trading is about minimizing risk, not maximizing profits. Profits come from trading well, not just from attempting to pick the next big winner. It's been my experience that the majority of traders focus on profits with little to no regard for minimizing their risk. When I do public presentations, it's common for me to ask the audience if they use stop losses or have exit strategies, and every time I ask this, only around 10% of people put their hand up saying that they do. That's like driving towards a cliff and not knowing where the cliff is. In contrast, the most successful people in the market that I know consistently average a good return on their portfolio by minimizing their risk. That means they know when to get out. In fact, not being exposed to heavy losses is in itself one of the key principles to successful trading. I'll say that again. Not being exposed to heavy losses is in itself one of the key principles to successful trading. Now back to stop losses. What are they? Well, a stop loss is quite simply a price point which you commit to selling a security. It is used either to preserve capital when a recently entered trade turns against you or to protect the profits you've gained on a winning trade. Now, it's important that you decide on your exit strategy before you place a trade, as it is usually too late to do this when a stock is falling. It is also the worst time to do it. The reason for this is simply because your money's on the line. Now, when your money's on the line, then the fear of losing is greatly amplified and you make emotional rather than rational decisions when it comes to holding or selling. Sound familiar to you? I find it's often the case that the trader struggles to admit once they have taken a position on a stock that it just did not do what they expected or they've made a mistake. It is hard to be objective when you're losing your money unless you have a solid strategy and rules to follow. For those of you who have been on our website and you've looked at our courses, you will know that there is a 60-second trading assessment that you can take to assist you. Now, would it surprise you to learn that around 90% who fill out that survey tell us that they know how to buy, but they don't know how to sell? When I chat to these people, I find that whilst they say they know how to buy, 90% actually do not know how to do that either. Well, not in my book anyway. Just placing a trade with a broker is not knowing how to buy. Buying is about solid analysis, rules, and skills. And 90% of traders are lacking in these areas. But let's get back to selling. Knowing when to sell is the more important aspect of successful investing or trading. Learning this will dramatically change your outcomes by reducing your losses and increasing your profits. In fact, knowing when to sell will seriously add thousands of dollars into your bank account. So how do you calculate a stop loss? Well, when calculating an initial stop loss, you need to use the most recent price available to determine your potential buy price. Now, this will generally be the closing price for the previous day, week, or month, depending on your strategy. Now, it's critical that you calculate your stop loss before you buy. You do this so that you can work out the risk that you're willing to take with your money. When you calculate the loss you will suffer if the trade turns against you, this tells you what you are risking. And you may find that you do not want to buy the stock if that risk is too high. It just makes sense. After all, would you drive a car if you knew it did not have any brakes? It does not matter how fast or how flashy the car is or seems to be. Not having brakes means you're taking high risk. When it comes to actually setting the stop losses, there are a number of different strategies that you can consider. Let me say that setting stop losses on stocks can be challenging if you do not have solid trading rules for entry and exit. Because not having solid rules will mean you are inconsistent in your trading results. This then makes it hard to have anything that will generate consistent results, and you stay on the merry-go-round of the struggling, frustrated trader. Now back to stop losses. When setting an initial stop loss, as I mentioned earlier, what you are doing is limiting downside risk on any new trades entered. Given this, you need to have your stop loss close enough to your buy price to ensure you do not lose more than 2% of your total capital. You also need your stop loss far enough away from the price that the stock is trading at, so it has some room to move in case it falls for a short period of time after you buy it. The same rules apply for anything that you are trading. A huge and very common mistake that traders make is to set stop losses far too tight for fear of losing. When you do this, you end up getting the opposite result to what you've been trying to achieve. That is, you end up losing more money as you exit, only to find the stock turns around to rise again, and if you had stayed in the trade, you would have made some great profits. But what is too tight? Well, that depends on the market you're trading and your trading plan. Getting into this right now is not my intention, as it requires you to have a lot of knowledge around trading, trading techniques and technical analysis. If being a great trader interests you, then have a look at our courses on our website. And in these, I will teach you what you need to know at whatever level you are right now. Now, to keep things in context today, I will share with you how to set an initial stop loss on a big blue chip stock. Stop losses for spec stocks are different, as they can be for other markets. When setting an initial stop loss on blue chip stocks, there are a couple of options that you have. The first is to set a percentage of your buy price. Now here I suggest a stop loss you set should be around about 10 to 15% below your buy price. Where or how tight you set it in that range will depend on the volatility of the stock, as this allows for minor fluctuations in the price as the stock settles into the trend. Setting your stop losses too tight, say 5% below your buy price, leaves very little room for the stock to move and will decrease your probability of a winning trade. In fact, most often than not, a stop loss this tight is a trade killer and not a profit maker. Alternatively, you can set the stop loss at a price point where you know with high probability that you may be wrong in your analysis. Now, when I say wrong in your analysis, it may be that just that the stock did not do what you expected, rather than you actually applying rules, techniques, or strategies wrong. That said, the majority of traders I meet just plain get their analysis wrong. Now here's a rule. I recommend calculating both stop losses and then using the one that gives you the least amount of loss. So let's look at how you set a percentage-based initial stop loss. Let's say you decide that you want to buy XYZ investment company because you believe it will rise in a nice long uptrend. The stock closed in its last day of trading at $1 and you want to purchase the stock when the market opens the next day. Your trading capital is $10,000 and you want to use 20% or $2,000 to purchase the stock, and you wish to set an initial stop loss of 15% below your buy price. Now your stop loss calculation would be the buy price, which is $1, multiplied by 15%, and that equals 15 cents. Therefore your stop loss is your buy price of $1 minus 15 cents, which equals 85 cents. Now once the stock closes 1 cent below your stop loss of 85 cents on any day, you would sell to protect your capital. Now there are variations on this that we teach our students depending on the stock or the market. Once you have your stop loss, And remembering you're doing this before you enter the trade, you know you need to convert this into the actual money or the trading capital you stand to lose if the trade goes south. Remember, you do not want to risk more than 2% of your total capital. Therefore, your calculation would be $2,000, which is your trading capital, multiplied by 15%, which equals $300, or the amount of potential loss you'll be exposing yourself to on this trade. You then divide $300 by $10,000, or your total capital, and multiply this by 100, which equals 3%. Now, if you take this trade using a 15% stop loss, you stand to lose 3% of your trading capital, which is above the allowable risk level of no more than 2% of your total capital. Therefore, this trade is representing an unacceptable risk. Consequently, you need to reduce your stop loss until you reduce your level of risk to 2% or below, which in this example would equate to a stop loss set at 10%. The second stop loss you would need to work out is the price point where you know with high probability that you are wrong in your analysis. This stop loss is determined using your entry rules. For example, if you bought when a stock crossed above a trend line, you would know your analysis was wrong if the stock traded back down below the lowest low immediately prior to the stock trading above the trend line. This is because a stock in an uptrend continually achieves higher lows or troughs, but when it makes a lower low, it suggests that the uptrend is failing, and so you should exit to protect your capital. For example, on the screen now you'll see the price is traded above a downtrend line on the chart, and there is 2 weekly closes above it. Now, this is a pretty standard buy signal. Now, whilst there are other analyses that you can and should apply to each and every trade you do to improve your probability of success, let's just keep things simple today and you decide to buy on 2 closes above the trend line. Now you can see after buying, price fell away and you would have exited at a 5.34% loss. Now if you'd used a percentage-based stop loss, you would lose 10 to 15%. So in this example, it makes sense to use the lowest low as the exit to the trade rather than a percentage stop loss of 15%, as this would enable you to exit the trade with the least amount of loss. Now this does not work 100% of the time. You need to understand that nothing in trading ever does, but it works the majority of times. This is where traders constantly make big mistakes, as they tend to guess at rules and then expect them to be accurate 100% of the time. Now back to stop losses. Remember, once you actually purchase the stock, you need to recalculate the initial stop loss based on your actual buy price to ensure your stop loss is set at the right price point. Now before I wrap this part of the report up, what I've gone through I teach in my book, Accelerate Your Wealth. It's your money, your choice. So get out and get yourself a copy and review what I've just taken you through in much more detail. Also, if you're serious about trading well, then look at my courses. They really are a small price to pay for your success. So let's get into this week's stocks.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Okay, hasn't the market been exciting the last week in the US? And if you've been watching some of the news in the US, you'll see that there's still a lot of conjecture around about the US market, with people calling for March may not be a good month. The rally that we've seen may be just a sucker's rally, that the market is going to crash this year. There's a whole lot of negative news and positive news on the US market. So if you're a little bit confused about what the US market is doing, you're probably not alone, because even the experts can't get it right. In the early March is when the China-US trade war deal, whatever else is all supposed to be agreed upon. So I think that's the 2nd of March, and that's part of what they're talking about. Brexit is also happening, so that's a whole range of stuff that they're talking about with the US market. But to me, if you listen to market noise, you're going to get it wrong most of the time, because as investors, you just need to look at the stocks you own. That's all you need to look at. So if you want to have, like I talk about in my book, Accelerate Your Wealth, it's your money, your choice. If you just want to have a nice portfolio, nice growth portfolio, you need 8 to 12 stocks. That's all you need to worry about. You don't need to look at the world markets. You don't need to look at what everybody else is doing. You just need to look at the stocks in your portfolio and then find new stocks to buy as you're freeing up stocks, meaning you're selling some stocks, or what's the next stock you're going to buy, or if you've got some spare cash and you've got some more money to buy another stock, you can do that if you've got positions or available positions. For example, if you've got 10 stocks, and you've got some money to buy an 11th stock, then you go and buy 11 stock and you go and look for the stock, because stock specific is what you should be looking at, not the market as a whole. The market as a whole will get you emotional and make you making poor decisions, and you can have a really poor market condition but still have lots of stocks going up and doing very, very well, and it's your job as the investor just to find those. So we'll have a look at a couple of stocks today, but let's quickly have a look at what the Dow Jones is actually doing. And let me just bring up the Dow Jones so you can actually see what I'm talking about. So here's the Dow Jones over the last couple of weeks. You can see here, if I bring that up a little bit, just mark that up. This is a weekly chart of the Dow Jones. You can see here the current month, February, it's open at 25,062. And with a low of 24,883, closing at 25,106. So you can see here how the open and the close are very, very, very close together. That suggests indecision in the marketplace. Second thing that I'm looking at here is how far it is away from the high. Now, this is what I teach people in my trading mentor course. So if you want to understand the market, what stocks are doing, how to buy, how to sell, and how to really put a good portfolio together so you make more money, then have a look at our trading mentor course. It really is dirt cheap to get in and start to get some more confidence, and competence is really important. How are you doing it? How are you putting your portfolio, getting strategy, trading plan, all of that I'll cover in the trading mentor course. And doing that course will actually turn you into being a really good trader. And you won't have to worry about the market as much. And too many people are nervous when they're on the market or whatever the market's saying. So right now, as I said, the news is bad about the US market, but I wouldn't be worrying about it if I were completely in US stocks. I would not worry about it at all. And the reason is because I understand what I've got to do with my stocks. And I've also got to understand what I do to get new stocks and how I'm going to manage it. Doesn't matter what happens in the market. The US market could completely melt down 50 to 90%, and it wouldn't worry me one little bit, because I have a process and a structure and a strategy to protect my money and to make money. And that's really the important thing. Right now, I think the US market is looking a little weak. It is overdue for a pullback. We've seen 1, 2, 3, 4, 5, 6 weeks up. I still think it's got to come down. This next move, if I just delete that, will tell us whether it's going to be more medium-term bullish or medium-term bearish. So right now, I would expect the US market to come down to around that 24,000 point mark, possibly below, possibly down to 23,575. If it pushes all the way down to 22,644, then it's highly likely that low there that we saw back in December, that 21,712, that would be broken if it goes through that 75% level. So basically what we're looking to see over the next couple of weeks is for 1 to 2 weeks down around that 24,000 points. If you can do that and start to move back up again, then it will go through the high of 25,439 and move up and make a new all-time high. That's why I'm sitting back at the moment on the US market. I'm not super bearish on it. I am bearish for the next few weeks, but I'm sitting back saying, which direction is it going to go? We need to look at long-term momentum and direction, not short-term stuff. Too many traders look for daily moves, weekly moves, and saying 2 or 3 days or 2 or 3 weeks is a new trend. That's rubbish. It's not a new trend. What you want is a solid momentum behind you, the buying pressure over months and months and months to take whatever stocks that you've got on a run, and that's what you want to do. I mean, imagine trying to stop a train that's at full flight. So all we need to know is where the train's going. Is it going where we want it to go, or is it going in the opposite direction to what we want it to go? That's where we've got conjecture at the moment. We don't know whether the Dow is going in the direction being up, that we want it to go, or is it going to go down? And the next few weeks will tell us. So this next month roughly will tell us which direction it's going to go for the next 6 to 9 months. So right now, sit on your hands, don't do anything, just watch. If you've got stop losses on your stocks, please stick to them and make sure you're setting stop losses. Although that said, I know 90% of people in the stock market don't set stop losses. So, and that's one of the biggest reasons why a lot of people fail. Now I'm going to go into the stocks. If you just wait for 2 seconds, I'm just going to bring that up. Again, if you get into our website, wealthwithin.us, there's lots of stuff in there. There's articles in there for you to help you understand, and you can get my book, Accelerate Your Wealth. It's your money, your choice. You can get that on Amazon and all good leading bookstores throughout the US. So get your copy of today. We're getting huge feedback on that at the moment in terms of people wanting or getting good returns and really enjoying the book, and finally now understanding how to manage a portfolio and how to get into stocks and how to be profitable for it. First stock, where I got these stocks on, I just Googled around like I normally do and just said, okay, so what stocks are in the media right now? What stocks do people or analysts think that are good or for the coming year? And so that's all I do, is just like, well, best stocks for 2019 or hot stocks or stocks in the news, just to find some stocks to see what's going on. Looking at this one, this is Wayfair from a stock point of view. It's looking like it's okay. It is trending all right. This is a weekly chart. It looks like it's trending up nice. I think it is a little bit more bullish, and I don't mind this stock actually. But if I look at the last few weeks, you can see it's a little bit different than the Dow. It's had a low back in November, a little bit earlier than the market itself. It moved up to that high of 114.69. It tested the low, and now it's moved through this previous high. So I think it's nice, it's actually more bullish at this point in time. That said, we got 1, 2, 3, 4, 5, 6 weeks up. So don't be surprised you see 1 or 2 weeks down and move through. But this could be good, a nice opportunity. If you're going to look at getting into it now, I'd sit back and wait for that move backwards. And that might be 1 or 2 weeks, and then get in after that. You'll pick it up at a slightly lower price, and you'll pick it up in a nice uptrend, and it should do very, very well. The next stock I want to look at is FedEx. Obviously, everybody knows who FedEx is, and they do make a fair amount of money. Looking at this, it had a huge move down in December, and look at that $83 range, and it is moving. It did move quite heavy. If I just scrunch that up, you'll see here how this stock actually moved. And let me just bring that up a little bit. You can see the momentum of this stock. If I whack on here a nice little trend line here, I'm just using the trend line tool, but you can see here how the momentum of this stock, if I can just click again, what I do is I look to see momentum, and you can see here that on these peaks and troughs all the way through here, this level and this green line is more momentum. And for people that don't understand, a trend line is a momentum indicator. I don't pretty much know most people don't understand that. It measures time and price all in the same line, but it didn't surprise me, or doesn't surprise me, that Amazon's fallen to that line. Now, the point we need to make now, is it going to, Amazon, I'm going to cover that in a minute. FedEx, sorry, it's hit that line and it's found some support. Now the important thing is it going to stay above that line or go below it? But if we look at the history of this stock, right back here, it doesn't spend a lot of time below it. It spent a couple of years back through here from about 2008 through to 2013, but it spends most of its time up and around all that. So if it does fall through it, I would expect it to be short term. Looking at it on a monthly basis here, you can see here how we had January was quite strong, but February is a bit weak, so I would expect to move down. This move down, if it does start moving down through the rest of February and start into March, then that low of $150.94 will be broken, but don't expect it to be broken for too long or below that green line for too long. Next one I want to look at is Abermail Corp, another one that, as I said, I found there. It's had this beautiful movement down here, a very, very strong movement down here. Well, let me bring up the monthly chart. And again, you're seeing a stock that's it's pulled back quite well, which is what I look for in stocks. I always look for stocks that have been falling away, good stocks that have been falling away, ones that have good fundamentals, make profits, and then look for them to start to rise, because you can pick up some good pricing here. Now, its all-time high was back over here. If we look at there, back in November 2017 at $144. Currently, it's at $70. So if I put, where's my little tool here? Where it is? There it is. If I whack my little tool on here, you can see here it's sitting on 50% of its all-time high. So this is a really, really strong point. So 50% was $72, it hit $71.89. This is looking really, really good at the moment. That said, tiny little bit too early. I'd like to see a move back up and testing this low at 71.89. So I'd like to see 1 month down and then starting to move up. If that happens, this could be an exceptionally good buy over the coming year or two. So watch out for Albemarle Corp, stock ticker code A for Apple, L for Lima, B for Bob. But as I said, just wait for a little bit of a move up, back down to test that low and then take it from there. But okay, looking just on a weekly basis, you can see here how the low is there, that 71.89. It moved up for a week, down for a week, and it's found some support. So it is looking all right. It looks like might find support, but I do need to see a little bit more of a move down over that monthly bar into that monthly low just to make sure. I'm always of the opinion, wait for the dust to settle a little bit, see what it's going to do, see the direction like I was talking about before actually really jumping in too early, because you might be catching a falling knife. I want to get into Alibaba. It's always been in the news, and a lot of Chinese stocks are in the news in the US because of all of the rorting that was going on with backdoor listings and everything that I talked about a little while ago. Right now, Alibaba is under some stiff competition. It has had a move down through here. You can see the whole history of Alibaba here. If I put that tool on again, you'll see that it's fallen about 38% of its all-time high, which is nice, and just remains to be seen whether it can hold up at those levels. If it can't hold up at that level, then it's heading down for $105. But let's go to the weekly chart and have a good look at that, and you can see here how we've had 1, 2, 3, 4, 5, 6 weeks up. It is looking weak, so this downward move, we'll see whether it's going to break through its all-time high, whether this move up is sustainable and it will get through that $211.70. So right now, a tiny bit too early for Alibaba. Like some of the other stocks at this point in time, I do expect it to come down for 1 or 2 weeks. If it can come down for a short period, not a very long period, but just a really short period, a couple of weeks in time, and it can stay above 151 and start to move back up again, I think this could be a nice buy as well. The next stock I've got is Amazon. Again, Amazon's always in the news. It's expanding around the world, and you can see here how it's been a beautiful, beautiful stock to own since after the GFC. If you'd bought it straight after the GFC, you'd be pretty happy if you're still holding that now from that perspective. But looking at it at the moment, I don't think it's finished falling yet. I think it's still got a bit further to go, and looking at this, it's looking like it's falling over at this point in time. If it keeps falling, and let me put this little tool on it and just get here. So I think if you own Amazon right now, I'd be looking at having my stop losses in place just in case. So let's move over here. So if it holds above this $1,521 mark and starts to move up, then we could see it move straight through and get through its all-time high at $2,050. If it starts to fall through down to the 61.8% or 75%, like $1,414, then it will break below that $1,307. So right now, if you own Amazon, just sit back, make sure you've got your stop losses on and take them if you do get triggered. If you don't own it, plenty of time, sit back, wait. And that's really what I'd be suggesting, sitting back and waiting. And that's all the stocks that I've got for you for today. So if you do want me to look at some stocks for you in the US, I'm really, really happy to do it. If you've got any questions, please do that. You need to comment below. Also, click that like button right now, because the more you like it, the more we can do more things, more people watch it, the more I can do there as well. So please comment below or anything you like. If you've got questions, happy to answer those. But if you do want me to look at a stock in the US, please do that and put that down below. So that's it for me for this week. Good luck, good trading. Talk to you next time.